This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money. Hello and welcome to Alternative Thinking, the podcast with me, Melissa Griffiths and Steve Dobson. This podcast aims to take a deeper dive into the alternative marketplace and topical issues. Today's guest is Lee Coates from ESG Accord, who has returned to discuss now the fund labels and SDR, really in relation to wealth managers and advisors. Lovely to see you again, Lee.
Good to see you too.
Yeah, welcome back, Lee. And just to recap for anyone who missed the previous podcast, Lee came in and talked about the labels and SDR requirements for fund managers. We looked at the actual labels, what they were, the timelines, implications for the fund managers in reporting, and what they couldn't do if they didn't adopt a label. So as Melissa said there, we're going to talk more from an angle of the wealth manager and the advisors. So given fund labels are coming, we know it's a thing, it's going to be happening very, very soon, and we know the reasons for them. What should advisors now be doing differently when they're talking to their clients, if anything?
Well, if anything, yeah. They can retire if they're not talking about it. That's option one. Actually, no, that should be the last option. Option one should be to get ready for the first meeting on the 31st of July. I don't even know if that's a day of the week, but assuming it's a day of the week, everybody listening to this, of course, will know it is, and yep. I haven't looked it up. But anyway, on the 31st of July, first client meeting, they have to be prepared to go, right, the rules have changed. The world has changed. From today, I'm required from my regulator to talk about these new sustainability labels and the context in which they sit. That's what advisors need to prep for. Mm-hmm. And it's not long until the 31st of
it's
July.
Very soon.
No, which is why I think this podcast is really useful for a lot of wealth managers and advisors. But one of the big things as well that they've really had to already tackle is consumer duty.
Yep.
And this obviously really emphasises even more the requirements on this. Can you touch a bit more into consumer duty and the...
I'd rather not touch consumer duty at all. No, it's a lovely thing. Well, theoretically, if an advice firm has its consumer duty fully embedded and up and running, mm-hmm. and we have had a sort of a year's honeymoon.
Yes.
But 31st of July 2024 is the first consumer duty reporting, so everything needs to be in place by then, which is a coincidence, but it chimes with the labels. Then slotting in sustainability is fairly normal. Where I think that generalisation falls down is that it presupposes that every advisor has already been discussing sustainable and ESG and ethical with every client, which is a requirement of consumer duty. You won't find it mentioned in the policy statement, but as consumer duty has PROD and COBS rules built in, then understanding and know your client
yes.
is a requirement of consumer duty. Now, it's not know your client except the bits you can't be bothered to talk about, mm-hmm. Or not experienced in or don't feel confident in. It's know your client. So if you don't know whether your client would invest sustainably, and most people don't have it tattooed on their forehead, then you have to ask. So if you have been asking, SDR slots in as normal. We discussed last year your sustainability preferences, and you said you weren't interested, which is absolutely fine. I just have to let you know that 31st of July 2024, a whole new label set coming, which I'm required to talk about. So I've talked about them. Actually, that isn't enough, because under consumer duty, you have to demonstrate informed choice. So unless the client has actually been able to read about what the labels are, or the advisor takes an hour to explain the labels, then that would be in breach of consumer. It gets deeper and deeper the more you get into this. So informed choice, understanding your client are all nothing to do with SDR. But what SDR does do is actually make it easier.
Well, it's another conversation, isn't it, that really needs to be on your checklist, I guess, as you're going into all your client meetings as we get to the 31st of July.
Why I say it makes it easier is because before the labels, or up to the 30th of July, any fund can call themselves anything, green, planet friendly, whatever. Whereas under the label regime, if advisors are following the rules and talking to the clients about these new labels, then the labels become the focus.
Yes.
Rather than this sustainability thing. Well, how do I know if a fund's sustainable? Well, it's in the name. Is it? Well, that one's green and that one's green friendly and that one's planet friendly and that one's sustainable and that one's ESG. So what's the difference? It's a minefield. Whereas now if it claims sustainability, it's got a label.
And how easy do you think it would be? So advisor has the discussion with the client, asks the preferences, etc., around ESG and sustainability. How easy is it, do you think, for them to tie the responses from their clients into the labels that have been prescribed by the FCA that the funds are going to be adopting from the 31st of July? How do they navigate that and match the two, I guess?
Yeah, well, it's back to basic target market client segmentation. So if you think about it logically, if a client, let's say you send something, we recommend you send something to the client that explains the labels before. Yeah. I mean, the FCA has a website, so you can just put a link in and go, could you have a look at the FCA's website? Never a problem sending a client to the FCA. Mm-hmm. Don't try and read the handbook, because nobody reads it. No, everybody does. But clients aren't going to. But go to this page, it's written for you, you're the consumer, just explains the label. We're going to talk about that at the meeting. So that sort of pre-knowledge. If a client then comes in and goes, I really like this improvers thing, then the advisor's thinking, okay, target market. I know this is an accumulation client. I know this is a high net worth client. I know I'll be thinking about tax efficient products. So I'm already building a picture of the client. The client said improvers. So what I now need is a tax efficient product with an improvers label. Mm-hmm. And the target market statement for that alternative investment improver labeled fund will say this is for people looking for an improver's investment strategy. So there's actually much easier than, I keep saying it, but how do you tie up green, planet friendly, sustainable ESG? How do you tie that up to a client's requirements? Whereas if the client's read something, I love improvers, think it's brilliant, then can I have an improvers version for my inheritance tax planning scheme that we've been talking about for a while? Can I build that in? Yes, I'll go and find you one.
So there's a little bit of homework for the end investors to do here first, ahead of the meeting, really, to have a base understanding of what these labels actually mean.
Yeah. I mean, we really do. It's a serious recommendation that advisors get the client to do a little bit of homework. I mean, there are groups like Money Alive are producing. We help them produce a box set around the sustainability labels and how it ties in with conventional investment. It's product agnostic, so I think it will end up being perhaps 8 to 10 minute watch. So do that, or you can download our explanation from our website for free. Advisors can use that, but send something to the client to read beforehand. What you don't want to do is go through a process of updating, if it's an existing client, updating a fact find and go, right, new rules are coming, I now need to explain. Because how much time do you spend explaining this new thing within a limited time the client's possibly paying for? So better to get them to do the homework in advance, because if you actually ask them to read a document in the meeting, there is a bit of, coming back to consumer duty, there is a bit of consumer duty called sludging, which is that if you have a process or an action that could be used to skew the client in a different direction away from where they may want to go, that's sludging. So for example, I give you 3 pages of A4 to read and then watch you reading it, you're going to start to feel very uncomfortable probably by the second paragraph. Yeah, because you're watching me, watching you read something, you want to get through it as quick as possible. So if that's maybe inadvertent tactic, but if it's something an advisor does, I'll get them to read it in the meeting. Unless they leave the room and say, you've got as long as you like, press the buzzer when you, and we'll unlock the door and come back in again, a police cell, then client's going to feel uncomfortable. So just, can you read this? Yeah. Just give it a broad look and we'll talk about it at the meeting. That's the way to introduce it, and then you're straight in. Do you read it? Yeah. Understand it? Yeah. Got any questions? No. Are you interested? No. Not interested. Yeah. Fine. Under consumer duty, again, coming back to that, you need to record every conversation with a client around sustainability, and it's as important to record I don't want this. Yeah. Right. It's not about, does the client want it? Yes. Okay, then I'll go through a process of recording that. It's, no, they don't want it. Did they make an informed choice? Do they understand that what it is they don't want? Was it just, do you want ESG or not? Because there's a lot of advisors have, do you want ESG question in their fact find. Worst place you could ever put it, because what's ESG?
Exactly.
Yeah.
How much time have you got to explain it?
And I guess in terms of sort of selection, if a fund doesn't have a label, where is the advisor then? Do they naturally presume with the client that those funds are not going down sustainability route? Or because that's not necessarily the case, is it? Because it's not mandatory to have the labels.
No, it's not mandatory to have the label, but it's mandatory to go through a disclosure process and be upfront in terms of documentation.
Yeah.
So you've got 4 labels, and you've got the sustainability characteristics option. So whatever, if a fund is operating in any way in the sustainability space, then it needs to have the documentation upfront and available. It needs to be written into its target market statement that it incorporates sustainability. So advisors are going to know, but by default, if there's no information at all around sustainability, then it is reasonable then to assume that any product that doesn't have sustainability built in is perfect for a client that says, I don't want sustainability built in. So then you're back to target market client segmentation. So all the labelled products and the sustainability characteristics are suitable for clients who have opted for that option.
And I guess this really does give a clear filter now to be able to filter out those that are going to be sustainable and those that aren't they?
Yes.
It really does kind of define it now for the advisors.
Yes, and I say, putting it into 4 very clear labels, well, 3 labels plus one that incorporates all of them, like the old-fashioned sexy managed fund. I go back long enough to go, everything was with profit, and then unit linking came in, and then, we'll have a managed fund because it's got everything in it. That will do, 100% managed.
Mm-hmm.
So when it comes to the wealth managers as well now, I guess they still do their due diligence as they would as historically to select the funds that they can put in front of their clients. I guess this in a way makes it easy for them, doesn't it? Because the labels are there, whereas prior to this, there was a lot of terminology used in documentation, or funds could use them in documentation. Now we've got the anti-greenwashing and the labels combined coming in. It should theoretically be easier for the discussions to get to the end point.
Yeah, especially around clients who want to see results. Or sort of anticipating results. So if you go for improvers or go for impact and say, well, what's actually happening with my money? I've given it to you. You've given it to this investment manager who's done my tax efficient investment for me, which I'm very happy with, and it's great. But what's actually been achieved? And so you've got this reporting. Whereas until the new regime comes in on the 31st of July, basically a fund manager can say, yeah, we're doing it. We're talking to companies. Oh, I'm glad you're talking to them. That's nice to know. But what are you talking about? I can't really tell you. Why not? Well, a bit tricky. We've got non-disclosures, all sorts of things. So basically what you're saying is I have to tell my clients to give you money to do something you're not going to talk about with companies you can't tell us, and the results of which you can't tell me. Yeah, that's right.
Yeah.
Okay, that always wins, doesn't it? Yeah. Whereas disclosure is you can't claim it unless you do it.
Yeah.
So if you say we're engaging with companies, can I have a copy of your engagement policy? We haven't got one. So what does engagement mean to you then? And how is it consistent? And is it consistent across all managers? And are you asking every company in a certain area the same thing? Because that's what an engagement policy is, surely. Mm-hmm. So really you can't do it unless you've got a policy. And then under the disclosures, you have to say who you're talking to, what you're talking about, red lines, what happens if they don't meet a target by in 5 years' time, what are you going to do? You have a disinvestment policy, slightly different in the alternative investment market. But where it becomes interesting, alternative investments, is what's your exit strategy? Because if you're an alternative investment manager not having a conversation about sustainability with a company that might be operating, because a company can be doing something sustainable, you're just not making any claims about it. Mm-hmm. But when you come to sell that or move that stock on, there's a really good chance that the companies that are going to be buying that company from the alternative investment manager are going to have a due diligence thing. So is the company doing this? Well, we never asked them to. Why don't you go and ask them? No, we're asking you because you're selling the stock to us. So you have never asked them to produce a report. Okay, and they don't do any of this. Well, they probably do, but we don't. We're not operating in the sustainability space. Okay, so we have to do all this extra work. Or there's another company owned by another alternative investment manager that's got all the answers. We can plug and play. Because when we buy that stock, we are accountable. We have to disclose carbon
Yeah.
emissions. We have to disclose this. We have to look at the governance. So if you're making it hard for us, we'll go and buy it someone else.
Yeah, that is interesting. And I guess, obviously it makes people accountable, firms accountable, and there is a measurable angle. In terms of for the underlying clients, how do they see SDR in reporting? Is it different to the reports they're receiving from funds? Is there a separate reporting side?
Yeah, it's a completely separate process. So you'll get the annual fund information and disclosures, which are all obviously financially orientated. But there has to be a completely separate document, which will be the annual sustainability disclosure statement, which confirms what the policy is and how that policy has been applied over the previous 12 months. So at the time the advisor made the original recommendation, they would have handed over the consumer-facing disclosure, which is 2 sides of A4, and explains what the fund's trying to do, what label it's got, how it does what it does, and it has KPIs set in there. So 1 year down the line and 2 years down the line, you've got stated KPIs. Are you meeting the KPIs? If you're not, is it you or is it the companies you're investing in? If it's the companies you're investing in are not meeting those KPIs, then we need an explanation.
Yeah.
So it's stock by stock explanation as to how your investment strategy ties in with your sustainability claim.
And just sort of going a bit wider, how do you feel the UK's regulation of this compares with Europe and the US on a sort of wider scale? Do you think we're going down the right path?
Right. We're talking about a US now, down the right path. Capital R. No, shouldn't get political. It is thing. It's ESG and sustainability is a political thing in America. It's incredibly difficult. You can go state by state and get different reactions and legal repercussions for claiming that you do ESG in different states. So you can't even say you do it. But the big comparison is UK, Europe. And Europe were the sort of first movers on this, introducing SFDR and their Article 6, 8 and 9 funds. And they've tweaked it as they've gone along. The advantage, it's not being critical of the EU, but any first mover gives everybody else the chance to go, oh, we're not doing it like that, we're doing it like this. It looks like the EU are moving towards a label-based regime now, away from where they were, having looked at where the UK is going. And the UK government wants to be the gold standard for sustainability in financial services, and be the place that other regulated countries look to. And not necessarily copy. They'll all do their own thing, but obviously companies operate internationally. So having to operate to 50 different sustainability standards is no help to anybody. So there are bodies that are trying to pull things together, but the UK, where it is now, is looking to be, as I say, the gold standard, and others will follow. When you have political differences, it does create problems, but there's no doubt that better investments are made with better information. Yeah. So you can decide not to buy a company as much as you can decide to buy a company based on what it's telling you. And the more uniform that disclosure and the more accepted that disclosure, the easier it is for everybody.
And I think that's very encouraging for our space, isn't it?
Yeah, definitely. Just something you said there, probably last question is, so obviously you mentioned there about KPIs will be set for companies to adhere to, so obviously they meet the requirements for that investment that the fund manager's made. What if the fund manager himself or herself is not making the investments that meet the label they've adopted, applied for? Can they lose a label? Can the FCA take labels away? And I'm just thinking in our space, because a lot of these, because to get the tax efficient benefits, you've got to hold them for a period of time.
Yep.
You're going into these long term on the back of a label at the outset. So what is the repercussions? What could happen?
It adds a different dimension. Part of the requirements are you have to look at the life cycle of the investment, which is interesting in the sort of mainstream equity-based investment strategy, where you hear a lot of fund managers, I'm not going to make any friends saying this, a lot of fund managers saying, yeah, we take a long-term view and then the turnover rate's 30%.
Yeah.
So do the maths. How long are you going to hold a stock for?
Yeah.
But with obviously alternative investments, yes, you've got a requirement to get the tax benefits to hold on, which means that at the are you going to make the investment stage, you're going to be looking ahead to whether the company can do the things that you are claiming you will do when you do your stock picking. So it's what you claim, whether they can deliver it, and if you don't think they can deliver it, then is it the sort of investment you should be making in a fund where you're claiming the investments you're making meet that? But looking further ahead, is can they do it, and then is that part of a good exit strategy? So a well-managed company producing good information possibly might come out at a premium, but it doesn't mean you put a ton of ESG and sustainability requirements on a company day one before it's made its first product. But having the conversation, we're in this, we're going to be out in 5 years or however long the period is. We will gradually ratchet up. We'll have conversations with you. We'll help you introduce it. It's in your interest. It's in our interest. It rests. If we can get a premium on the way out, everyone's a winner. Because we don't want the opposite, which is now we haven't thought about this, and people start asking nasty questions when when we want to get out. So I think they're alternative investment managers because it's much more hands-on. They're in the companies. They know the management. They can have that personal discussion.
Yes, so I think really, again, Lee, if wealth managers and advisors are interested in talking to yourself, ESG Accord can help, and what would you be able to do for them? For advisors, wealth managers, we have a free-to-access website called Accord Initiative, free to register for financial services professionals, and the documentation, client explainer, so information to send to a client that's Consumer Duty, we hope would be FOS friendly and SDR friendly, free to download, thanks to the support of companies in the industry. Brilliant. All right. Well, thank you once again, Lee. That was really informative. And hopefully we'll be speaking to you again soon.
Yeah, be good. Thanks very much for your
Thank
time.
you, Lee.
Thank you. To hear more from Steve and I, tune in to either YouTube on video, or we're also available on all good podcast channels.